Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He's worked in the oil and natural gas industry for over 30 years. He has one of the top paid investment research newsletters for oil investing for over a decade now, and his articles routinely appear in Forbes about oil, natural gas, nuclear power, and renewables. Robert Rapier, thank you for joining me again.
Thanks for having me, Jason.
So, Robert, in the mainstream financial media, we just see articles coming out about oil for the last 6 weeks talking about demand destruction. I see this phrase just repeated constantly. Is there any actual evidence, though, that oil and gasoline, jet fuel, diesel demand, that demand destruction has actually occurred, a lot of it?
No, not really. In fact, I'm just looking at the weekly petroleum status report at the EIA. Our current demand is as high as it's ever been for oil. I'd have to look and see where gasoline is relative to previous years, but I suspect it's probably right there as well. I'm going to pull that up actually while we're talking, but I suspect the weekly product supplied on gasoline is. I'll tell you in just a second because I'm pulling it up here at the Energy Information Administration. All that information is available. So, our weekly product supply of gasoline is 8 million barrels a day. It's a little off of where it was pre-COVID, but it's been 8 to 9 million barrels a day for a long time. If I look year over year here, relative to where we were last year, we were about, we're down, we are lower than we were last year. But part of that is probably price. I mean, price is going to have some impact. It doesn't have a huge impact on people's behavior, but it will have some impact. We hit, during the summer, we hit, 9.5 million barrels a day of gasoline demand, which is, up there, about normal for a summer.
And we're recording this interview on Monday, September 12th, 2022. West Texas Intermediate crude prices, they're down about 20% over the last 2 months, down to $88.21. Natural gas prices here in the US are still very, very high. They were down in the last week or two, but now we've had a nice little rally today, up over 8. Do you think that with the Saudis announcing production cuts, do you think that if the oil price continued to show weakness, the Saudis would consider additional production cuts?
Oh, I'm sure they would. I mean, they like $100 oil, and they'd like to see that prop back up. One of the things that has affected oil prices, and I said at the time it would. Biden earlier in the year announced this massive draw from the Strategic Petroleum Reserve, and we've drawn it down to the lowest levels now since 1984. That's obviously not sustainable, but it has dumped a lot of oil into the market that the market had to absorb. And that did help break prices back below $100 a barrel. But that is not sustainable. We can't keep pulling that down. So the hope was always that production would catch up. Production has been slowly increasing. The rig count's been going up. And the hope was that if we could make it through the summer, then maybe production has caught up substantially. And that will help, and they can stop the drawdown from the Strategic Petroleum Reserve. It was the most blatantly political use of the Strategic Petroleum Reserve we've ever had. I mean, presidents have used it many times before politically leading up to an election, but this was a massive draw on the Strategic Petroleum Reserve. And if we did have an incident where we needed it, this would look like the dumbest move in history regarding the SPR, because that's there as an insurance policy in case we get cut off from oil. And if we got cut off from oil, our emergency this summer has been, people don't like paying a lot for gasoline. And that's been the extent of our emergency. Natural gas is a different ballgame entirely because, with Russia potentially cutting off natural gas to Western Europe, and the U.S. trying to help fill that void, gas prices are high, natural gas prices are high. Our storage levels are low headed into winter. I just saw an update from Cheniere Energy. They gave a fantastic update for the rest of the year. They said, profits are going to be good. We're going to buy back more shares. it was a really, really good outlook that they gave for the rest of the year. And that's partially, Russia. I mean, in the long run, Europe is not going to want to rely on Russian gas. More than ever, they're going to want to get off of that, and that will benefit the U.S.
And Cheniere Energy just announced, I think in the last month or so, a very big contract to expand their LNG exports facilities. I think they got a big contract from China. It's either PetroChina or one of the three major Chinese national oil companies. So there is a lot of long-term demand for natural gas out of Europe, Asia, emerging markets.
Right. And I'm just looking at this press release from Cheniere today. They updated guidance and capital allocation. 12% increase in 22 EBITDA guidance. 2022, I mean, we're more than halfway through the year here, and they're increasing EBITDA guidance by 12%. 20% dividend increase, $4 billion stock buyback over the next 3 years, and they have pulled down debt by $4 billion. So that's a pretty substantial outlook improvement. I looked at shares, and they were up in the aftermarket, about 2%. But that's a really, really attractive proposition. I mean, they're positioned to really capitalize on this situation in Western Europe.
Now, I know you look at these companies a lot on a daily basis. Are natural gas producers, so companies that have a 50-50 mix of oil and natural gas or more skewed towards natural gas, are they having record profit margins right now? And are those profit margins better than oil producers right now?
Yeah, the oil producers are still having the better profits. I mean, the margins on oil are generally always going to be higher than the margins on natural gas. Now, I mean, that may change this quarter with natural gas being so high, but we're still looking at very high oil prices relative to history. So, margin on a barrel of oil is generally a lot better than natural gas. I'm just looking at I think EQT is the largest natural gas producer in the country. It's up 131% year to date, so it's doing quite well. Let me compare that to like ConocoPhillips. They produce a lot of gas, but they produce a lot of oil. Their share price is up 55% year to date. But I think that's partially because natural gas prices were depressed, and a lot of the natural gas producers were depressed, and oil companies had already had a pretty good run up at the first of the year. Yeah, if I look over the past year, ConocoPhillips is up 100%. But a gas producer, gas has been depressed for such a long time, and those gas producers have been undervalued for such a long time. I think you're seeing now finally some of the valuation being realized.
I want to ask you about costs, because we had Diamondback Energy announce their Q2 earnings recently, and their costs to drill a new well are up 15% year over year. But I just interviewed arguably the top oil hedge fund manager, Josh Young, a couple of days ago. He said the industry is experiencing, the oil service industry, the drillers, the oil and natural gas producers in the US onshore, record cost increases the last 2 years. There's shortages of pipe casing for steel. There's labor shortages. They're having to pay higher labor costs. So in your opinion, how much are costs up the last 12, 24 months to drill a new oil and natural gas well? Are they up a lot more than 15% year over year for the industry average, would you say?
That's probably a reasonable estimate. I would say, 10 to 20% easily. And beyond that, there's been a severe frac sand shortage that has driven costs up. But the labor shortage has been bad. A lot of people left the industry permanently, and it's been hard to fill positions. I know that my company has had a hard time getting parts and getting very long lead times on items. So, it's all still supply chain issues that started up when COVID shut down China. It's just been a ripple from that we've never caught back up. We've never completely fixed the supply chain issues, and China keeps shutting back down, and that impacts the whole world when they do.
If these costs keep rising, do you think that that's going to affect free cash flow adversely? And then will that start to cause maybe some of these oil and natural gas producers, if oil prices do temporarily drop, how sensitive do you think are the dividends for some of these companies?
I think the dividends in most of these companies are pretty safe. I mean, take a Chevron, for example. Chevron didn't even cut their dividend when oil prices went negative in 2020. Shell did. Shell cut their dividend, but Chevron, they went on CNBC, their CEO, and said, "Hey, our dividend is the most important thing. We're not going to cut the dividend. We're going to maintain cash flow." The pipeline companies, they actually increased cash flow during the pandemic, and so a lot of those companies they saw a lot worse times in 2020 than they're seeing right now, and most of them managed not to cut the dividend. That's not saying that nobody will. If you're a marginal producer, you may, but if you're a marginal producer, you're probably not paying a dividend anyway. I mean, a lot of those marginal producers don't pay any dividends or really a token dividend. I think oil prices will have to decline more. So, I mean, yes, costs are up, but so are oil prices. I mean, I'd have to look year over year. I don't remember off the top of my head where we were this time last year, but I think we're still significantly higher than we were a year ago on oil prices after running up over $100, and so that helps offset those higher drilling costs.
So it probably depends on each company, because if I remember correctly, in the first quarter, early 2020, I think ExxonMobil borrowed a bunch of debt to maintain their dividend. Recently in the Q2 numbers, Schlumberger actually was cash flow negative. I was pretty shocked at that, but I guess a lot of these oil and natural gas producers are not drilling as much as one would expect. So Schlumberger—
That's exactly what I was going to say. So a Schlumberger, I could see them going cash flow negative just because the oil companies have had more capital discipline this time around. They said they were going to. They said, we're not going to make the mistakes of the past. We're not going to go and load up the farm at $100 oil because we know that's not likely to sustain. So our rig count, even though it's up like 60% year over year, it's still well below where it was pre-COVID. And our production is still, 1 million barrels short of where it was just before COVID hit. And I think they've been very disciplined. And so that's why a Schlumberger is maybe getting hit a little bit harder than, some of these oil companies.
I think it also says that Schlumberger, like in the past, normally a lot of these oil service companies and the drillers, just to get business in a bear market, they would have to lower their prices. So to get any revenues, they would have to cut their prices and they would have to run break even or at losses. So what that tells me, if they're cash flow negative on Q2, they're going to have to raise their prices.
Yeah.
So I'm anticipating like big price increases from Schlumberger, because they maintain their dividend, but they can't keep running cash flow negative and maintaining their dividend. I mean, their balance sheet's going to be a mess then.
Yeah, I'm just looking. Schlumberger is up 27% for the year. That's well behind the oil and gas producers.
And in terms of growth for new wells, the U.S. has had mostly just growth from natural gas production, right? Because of the record natural gas. So the natural gas production growth has far exceeded the oil production growth. I think the same is the case. I think Norway is also increasing oil and natural gas production, but there's not a lot of countries that are significantly increasing their production globally yet.
Right. And I think the last time I looked, I believe we're back into record territory on natural gas production in the U.S. And globally, we were last year. Globally, the world set a new record for natural gas production, but we're still not back to where we were oil production. And some of that is just because, wells were shut in, companies went bankrupt, and companies are, like I said, showing more capital discipline here in this price environment. And so production is climbing slowly. I'm looking, it was 12.1 million barrels a day last week, but we hit right at 13 just before COVID hit. Now, a year ago, we were 10 million barrels a day. So we're up 2 million barrels a day year over year. But that rate of increase has been slowing down. The rig count increase has been slowing down. So, it's hard to say if we might ever get to the previous record. But definitely, we're heading there at a slower pace than we were 6 months ago.
Well, I also think globally there's big capex and supply issues with the comments that we've had the last 6 months, where OPEC and a lot of OPEC countries admitted they don't really have spare capacity. They're running at max capacity. And we see with their investment numbers that have come out, they're not reinvesting their free cash flow into growing oil production, into expanding reserves. That's just not happening.
Right. And the other thing is, I always tell people that why would OPEC do a favor for Biden and increase production to get oil prices down? They don't really like him. I mean, and Biden has not, he said very, very things they didn't like about Saudi Arabia, and they're not going to do him any favors. They're not going to go and open up the taps, even if they could, and I don't believe they can, but I don't think they're looking to do him any favors at all. I think they'd rather not see him in there. I think they'd rather do business with somebody like Trump. I think they would rather have Trump back in there, and so they're not gonna be helping Biden out in any way.
So I want to ask again about dividends, because a lot of these oil and natural gas producers in the US and Canada, they announced a base dividend and then they announced a variable dividend. And they've stated in their variable dividend policy that roughly 20% to maybe 40% of their free cash flow, I think Petrobras is 60% of their free cash flow, is going to be paid in a variable dividend for their oil and natural gas production. Have you run any like dividend sensitivity analysis for your dividend stocks in your paid investment newsletter portfolios to stress test to see if these companies, if oil does correct to say $70 a barrel, $60 a barrel, if these companies would have to correct the dividends, or how much of a cut potentially there could be?
Yeah, I don't think I'd recommend any that have variable dividend pieces. I'm in some mining companies that do, and some other companies like that, but I don't think any of my oil and gas recommendations do. So no, I haven't looked at that. I know that ConocoPhillips, in every quarterly presentation, they will break down all of their cash flow out and their incoming revenues, and how all of their cash breaks down in great detail. And then they will indicate what the sensitivity is to the price of WTI, the price of Brent, and the and natural gas prices, Henry Hub natural gas prices. So if you ever want to dig into that and really understand sensitivity, look at one of ConocoPhillips' quarterly reports, because they always, at least they always used to. I think they still do, but they break it down and really even show the sensitivity on profits to a dollar change in price of oil.
Oh, that's very interesting. Do you also think that smarter capital allocation for these oil and natural gas companies, you talked about capital discipline, do you think it would be smarter for these oil and natural gas companies that are actually producing to, instead of increasing dividends maybe, and getting mutual funds and institutional investors and retail investors just to buy the stock, to actually go out and buy assets that are at discounted cash flows, buy discounted reserves, that mergers and acquisitions would be smarter?
Right. And I used to look at that a lot. And I made an argument a few years ago that, an ExxonMobil or a Shell might want to try to buy BP, because BP's reserves on the books at that time, when BP shares were so depressed, they were on the books at only like $10 a barrel. And I said, Exxon's drilling costs are in that range. I mean, they could go and they could add many, many barrels by going out. I mean, forget about the, there would be issues with competition, antitrust issues probably with trying to add that. But from a strategic standpoint, I mean, ExxonMobil could certainly add a lot of cheap barrels if they had been able to go and buy a BP. But a smaller company, I look at that all the time. I look at what is the cost per barrel that these companies have on the books relative to, what's the market cap of the company worth versus how many barrels of reserves they have. And you can definitely go mining and find, I would often find that the cheapest ones would end up being takeover candidates. They would end up getting bought out. So other people are doing that same analysis. But, if you go and you look at the market cap on all these companies, and if you've got a way to pull in and there are many programs that can do this, pull in the barrels that they got on reserves, you can quickly break it down, and it'll vary a lot. The ones that have more natural gas will tend to be on the lower end of the scale because their dollars per barrel aren't as high as the dollars per barrel worth of oil. But you find some surprisingly cheap companies, cheap reserves on the books of some of these companies.
We're actually seeing a lot of natural gas deals lately. EQT just did another $5 billion deal. I think they bought a lot more natural gas assets and pipeline assets, and I think they're planning an LNG export facility, or they're going to go buy one. They announced plans for that. They haven't bought the LNG export facility, but they're announcing that they're working on one. But they did just buy about $5 billion worth of new natural gas assets.
Yeah, I was really, really bullish on EQT. That's one that I wish I had back, because I would sell covered calls on it, and I couldn't keep chasing it. My shares got called away, but I missed quite a run up with them. But EQT is a great company. I was too early on them. Maybe I was, 3-4 years ago, I was thinking, this is a really, really great company. And that was before they bottomed out. I still held shares when they bottomed out during COVID, but on the way back up, my shares got called away.
You mentioned how cheap BP was. There's political issues why, in my opinion, BP will never be bought. I don't think the British government will allow it. And the British pension funds, which own the majority of BP shares, I don't think they will allow it. So there's
that was a consideration as well. I mentioned that at the time. There will be, the British government will not want BP to be bought out. I don't know if they can stop it. Maybe they can, but just from a strategic standpoint, their shares were on the book for really, really cheap. I mean, their reserves, their reserves were really, really cheap relative to the market cap of the company.
Now, speaking of really cheap reserves, I have a lot of friends, like hedge fund manager friends, financial professional friends, who went and tried buying those Russian oil company shares, and they were Americans, and they were looking at the valuations and how cheap the cash flows were, how cheap the reserves were, the dividend yield on Rosneft and Gazprom, and then they got screwed when the rules changed. Do you think that Americans and other foreigners with the sanctions, are there going to be opportunities there, or do you think that people should stay away from this?
I think the average person should avoid it like the plague. And I generally steer people away from Russia. I think China's okay. I mean, it's been fairly stable, but I steer them away from South America too. Petrobras, I used to own Petrobras. I made a really good profit on it, but then the government stuck their hands in the pockets of Petrobras and picked their pockets. And I said, they tend to do that in South America. They have a different view on private companies, and private companies doing too well and oil prices are too high. They are going to force those oil companies to subsidize fuel, and that's what they did with Petrobras. And then of course you got Venezuela. I owned ConocoPhillips. I worked for ConocoPhillips. Hugo Chavez said, "Thank you very much. Those are ours now." And so I generally I approach South America very, very cautiously, and I usually will not recommend there. But I'd be the same way with Russia. I'd be really, really careful. It's high risk, high reward. If the situation over there gets resolved, there could be a lot of money to be made. But for the average person that I advise, I would say stay away from it.
And for listeners who didn't listen to the last interview I did with Robert, he talked about how he was working at ConocoPhillips when they were investing in Venezuela. They were bringing online a lot of profitable oil and natural gas wells. And then as soon as the wells became profitable, the Venezuelan government seized the assets.
Correct. And they've been ruled against in the World Trade Organization, the World Court. They've been ruled against again and again, and they recently had another ruling go against them. So, Venezuela owes ConocoPhillips billions of dollars. They've lost these court case after court case. And I don't know if ConocoPhillips will ever see the money, but, it has been ruled to be an illegal seizure in the World Court.
So do you think then the biggest risks for people owning oil and natural gas companies, pipeline companies, is windfall profits taxes from governments? Is governments putting new taxes on, either subsidies, trying to subsidize gasoline or diesel for poor people in those countries, windfall profits taxes, carbon taxes, rather than a lower oil and natural gas price?
I think the volatility of oil and natural gas price is always going to be the biggest risk, because that's global. That's, you're going to get hit by that no matter where you own a company. In the U.S., honestly, it doesn't make all that much difference if you look at the performance over time of oil and gas companies, of who's in power. The Democrats will have a more hostile outlook or more hostile relationship with oil and gas. But look how they've done under Biden. I mean, when he does things that restrict supply and cause prices to go up, that's very, very beneficial for the oil and gas companies. And I tell people that sometimes. I say oil and gas companies ought to be sending a thank you letter to Biden for the role he had in helping drive those prices higher. When he shuts down a Keystone pipeline and it causes supply to be short in the future and prices to go high, it's going to be profitable for the oil and gas companies. And, so I think, but I think in the long run, the volatility, oil prices run up to $100 and then back down to 30. That has way, way more of an impact than, windfall's profit tax, which should only kick in when profits get very high. I mean, it wouldn't have been a big deal if there was a windfall profits tax on Chevron or Shell when they're making record profits. I don't want to see that, but I don't think that's a killer for the business. It'll have a little bit of a chilling impact on investment, but I don't think it'll be a huge impact going forward.
Yeah,
I don't think they'll do it anyway. I don't think they'll get that through Congress anyway.
Well, the threat of a windfall profits tax, that'll stop supply. I mean, the companies will say in these countries, if these governments are going to ban oil and gas drilling, they're going to take away leases, they're going to put windfall profits tax or carbon cap and trade, we're not going to make investments there. There's going to be less supply.
Oh, definitely. That's the case in some countries. I mean, some countries, the risk is severe because a windfall profits tax in the U.S. is one thing, but a windfall profits tax in Venezuela may mean we're going to take all your profits. So, it just very much depends on where you're talking about. There are countries that are very, very risky from a business perspective and countries that aren't. The U.S. is not one, and most of Europe is pretty stable. But some of those South American countries, you just never know.
Well, the European Union actually, from a geological standpoint, they have plenty of oil and natural gas. They just have drilling bans almost everywhere. So they try to go green energy. They don't have their own domestic production. That's the major problem. They have to import everything from either Norway or Russia or imported liquefied natural gas. And then they don't even have the liquefied natural gas import facilities installed yet.
Right.
So it's just a total mess. I mean, it's not because they don't have the actual supply. They do. They just have all these policies, these government policies that have prevented the supply from coming online domestically. And then when you have to import, you're competing against Asia, you're competing against China, you're competing against emerging markets. I saw articles in the last month, Robert, where the emerging markets were supposed to get the majority of the liquefied natural gas, and instead it went to Europe.
Yeah. Yeah, and I think over time, Europe, they've got enough LNG import capacity, but not in the right places. I read that recently, that there's enough capacity, it's just not where it needs to be. And so over time, I think that'll get rectified. And I think going forward, Putin's invasion of Ukraine is going to be very beneficial for the U.S. because I think Europe is going to look to us for LNG. And I think they will be building more import terminals. They'll be signing long contracts with U.S. suppliers, and U.S. suppliers can supply it over there to, we have a low cost. We have low cost of production here in the U.S. So I think we can compete with anybody trying to put LNG into Europe.
Do you think that the U.S. will start to buy back the Strategic Petroleum Reserve after the November elections, or do you think this is going to take many, many years?
No, in fact, I read that even when they announced the drawdown, they said they were going to look at refilling it after 2023. And basically, they're not going to do it. As long as Biden's in office, they're not going to do it because doing that will risk driving oil prices higher. So I think he's going to either shovel this off to a second term or to the next president if he doesn't get reelected. And he's going to push that problem off to them.
Final question here in the interview. So the oil and natural gas stocks, a lot of them have had a nice little pullback here. I would say there's been an overreaction, even though the oil price is down about 20%. The US oil price is down about 20% in the last 6 or so weeks. Some of these oil stocks are down 30, 40, 50%. Do you think that there's good value there still? Where do you think is the best value right now in the oil and natural gas space, companies that have free cash flow and potentially good dividend growth?
So I ran my stock screen a week ago. I run a stock screen every week, and then I make a recommendation in my newsletter. And a week ago, ExxonMobil, BP both popped up near the top, but a new name popped up for the first time. I hadn't seen it on there before, and that was Suncor. Suncor popped up as a very huge value, and if you look, they've had a significant pullback recently. And so I made that a recommendation in my covered call newsletter. There's a lot of the pipeline companies are starting to catch up a little bit, but they've been depressed for so long. And Enterprise Products Partners, which I own myself, is still undervalued in my view. A lot of those pipeline companies, depending on what kind of investor you are. If you're an income investor, you want to look at the pipeline companies and the super majors. If you're more of a growth investor, you want to look at an oil gas producer, EQT, ConocoPhillips. A lot of them are well off their highs, and there is value there. But I always warn people, the bottom can fall out in oil prices. And I was warning people about that in midsummer. I said, look, if you go back to midsummer of 2008, oil prices were near $150 a barrel, and oil companies were all up 50, 60% for the year. And by the end of the year, oil prices had fallen into the 30s, and oil companies were down on the year, 30, 40%. So it can turn around very quickly. And I said the biggest risk here is that Putin waves the white flag and said, you know what, this was a huge mistake. We're going to come out of here. We're going to leave Ukraine. And, we'd like to normalize relations with the world. And some people would say, okay, we'll buy your oil again. And that has the potential to put more supply out there. And to because if you look at when gasoline prices especially started to run up enormously after Russia invaded, oil prices had been running up for the past year on supply chain issues and the inability for production to grow along with the demand rebound. But that's the risk. The risk is that there's a little bit of a demand decline because of high prices, and at the same time, more supply is coming online, and that can crush the price in a hurry. It always overreacts. It overreacts in both directions. It runs up too high and then it falls too low, and you don't want to get caught buying shares, when oil's $150 and then it ends the year at 30. That's you'll be years recovering from those losses.
Yeah, I suspect if oil prices continue to show weakness, so I think the Saudis will consider more production cuts. OPEC and the Saudis will announce more production cuts. It looks like they've already hinted at that. So I think we will see that. And long term, I think there are big supply issues because we're not seeing the reinvestment, especially by OPEC and these national oil companies. The Nigerian National Oil Company, they announced their earnings and they didn't even make a profit at triple digit oil. So these national oil companies, Pemex is another, they are having a lot of problems. Not all of them, because Saudi Aramco is minting money right now, and Petrobras is too. But a lot of these national oil companies are having major problems reinvesting and replacing reserves with capital.
Well, and importantly, this artificial supply from the Strategic Petroleum Reserve, that's going to end. That will end soon. I think in October it's supposed to end. So suddenly there will be, 500,000 to 1 million barrels a day that have been hitting the market here in the U.S. no longer hitting the market.
Okay, and that's a lot of selling pressure, and that's a lot of extra supply that wasn't necessarily wanted. It was just flooding and hitting the market and being stored then in inventory.
Right.
Okay, last question then. Since we briefly touched on oil services, do you think oil services then, what do they need? What do these companies need to do to start to outperform? Did they need to raise prices? Because it doesn't look like there's going to be a lot of new supply coming online here in the United States. How are these oil service companies then going to, like Schlumberger with the bad numbers, how are they going to fix things and start outperforming the other oil and natural gas companies?
Yeah, I mean, if oil prices stay high, they can afford to increase prices, and the oil companies will pay it as long as prices stay high. That'll cut into the oil company's capital budget. They may have to drill a little bit less, but ultimately, at Schlumberger, they've got to push price increases through.
So you think if oil prices are weak, then Schlumberger is going to be weak. They're not going to be able to pass those price increases along there?
Right. If oil prices weaken anymore, they'll have trouble with that.
And if a lot of Republicans don't win the November congressional elections, and with Biden in office, then you're not going to see a lot of drilling permits. And with the negativity, how oil companies here in the United States are being treated, then you're not going to see as many oil and natural gas executives. They're not going to spend as much as their capital budgets then on drilling new oil and gas wells. Is that what you would expect, unless there's a change in Congress?
I really don't think the president has that much impact on what the oil and gas companies are doing. It's just like the rig count has gone up 60% over the past year. And Biden's been hostile to the oil and gas industry the entire time, but they mostly ignore that because they know this is not a long-term thing, that somebody else is going to be president and things can change. And these projects they're doing last multiple presidential administrations. So, look at Keystone. They hung around for so long. They made it through Obama, and then they made it through Trump, and it was on again, off again, on again, off again. And then they finally said, hey, enough's enough. But I think what one president does just doesn't have a huge impact on the plans of these companies. I think they look and they say, okay, well, this is not, unless they pass a law that is going to impact them long term. I think they do what they were going to do anyway. And it may be marginally better or worse for them in present time, but and in the long run, it may be a lot better or worse for them depending on what is done. But a president in the short term, I think they have a minimal impact on what the oil and gas companies are doing.
So you think then unless something drastically changes, that regular oil and natural gas producers will outperform the oil service companies?
Yeah, I do.
Oh, that's interesting. I've had a lot of oil hedge fund managers on that think the oil service companies are eventually going to fix things, but they haven't. The shares have underperformed. So
if you look now, I mean, if you look from here and say, all right, from here, 1 year from now, I mean, the oil and gas companies are very, very high priced. I mean, they are. If there's a pullback, they're going to fall a lot more than oil field service companies because they're so elevated and they're so sensitive to oil and gas prices. But with oil prices where they are, I think the oil field services companies, they still got to try to push through price increases while the oil and gas producers are still just printing money.
But aren't a lot of the, sorry to interrupt you, Robert, aren't a lot of these US oil and natural gas producers, aren't a lot of the oil producers, they're hedged at $90, $100 a barrel, right? Didn't they lock in a lot of it? So if there is a drop, the shares would drop, but their cash flows, because they're hedged for a while at $90, $100 a barrel, their cash flows would actually be safe versus their stock price.
Some do and some don't. I mean, some have a philosophy on hedging. ConocoPhillips famously does not hedge because they said in the long run, it evens out and we're out the money that it costs us to do the hedging. So they said, that's 2 or 3% hit to our cash flow over time that we're not going to get back, and it's going to even out over time. And then I think EOG is pretty hedged. And so you do have to pay attention to that, depending on where you think oil, if you're worried about oil prices falling, check and see where companies are hedged and who's going to get hit. If oil prices are going to fall, ConocoPhillips is going to get hit a lot worse than an EOG.
It's a good point. Yeah, a lot of people are not aware of this, but the larger oil and natural gas companies, I think they have large trading departments and hedging departments now. So they could have a large group of traders on staff.
Yeah.
Well, Robert, I really enjoyed our discussion today. If my listeners want to follow your work, check out your paid oil and natural gas newsletters, how did they do so?
So you can follow me for free on Forbes. I have free articles there, usually once a week. Investing Daily, I have some free columns and some subscription columns. So the easiest way to find me is just Google Robert Rapier Investing Daily, and you will find my my newsletters.
Excellent. Well, thank you. And it's always very interesting times in oil and natural gas. I mean, I think we have a global food and energy crisis. Emerging markets and Europe and China are absolutely getting hit, devastated with high gasoline, high diesel, food problems. There's riots in the streets. It's not happening in the US. We have really bad stagflation here. Gasoline prices, diesel prices are high, but it's so much worse in many other countries.
Yeah, I will say that when I started writing about energy, it's been 17 years ago now, I thought I'm going to run out of things to write pretty soon. And I've never run out of things to write since then. I mean, there's always something happening.
And now you have a lot of countries, I think Japan's a major one, talking about restarting the nuclear power plants because they're having to import so much natural gas, so much oil. They're trade deficits. They're running trade deficits because of energy. They're not running their normal trade surpluses and their currencies are getting hit. So now these countries are saying we need to think about restarting nuclear power plants or investing in new nuclear power plants. We need other versions of cheap electricity.
Yep.